My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we're going to cover the basic elements of long-term notes payable. So let's get started. First thing that you need to understand about long-term notes payable is conceptually they are accounted for the same as bonds payable. So with bonds payable, we had to be concerned with the present value of the cash flows as well as the future cash flows and interest, and we had a methodology for recording interest expense and so on. Well, long-term notes payable is just another long-term source of financing, and conceptually notes payable is treated very similar to bonds payable. The significant difference between bonds payable and notes payable is that bonds payable are typically issued by the borrower, the company that wants to borrow money. They are issuing the bonds to investors. Notes payable are typically issued by the lender. So with bonds payable, it is the borrower that is in charge of writing the contract, or they have control of writing the contract. With notes payable, it's typically the lender that has the ability to write the terms of the contract. So there are going to be some differences between notes payable and bonds payable, and that is one of the significant differences. The other significant difference between the two is that, remember, bonds payable are typically issued in $1,000 or occasionally $10,000 certificates. Notes payable are typically just issued in total. It's one lender working with one borrower. With bonds payable, it's one borrower, but could be working with or borrowing little bits of money, $1,000 here, $1,000 there, from literally tens of thousands of lenders. So notes payable is typically just a single contract, by and large written by the lender, and so they are in control of the terms. Now, there are three types of notes payable, long-term notes payable, that we have to understand how to account for. The first one is the traditional interest-bearing note payable. And realistically, there is almost no difference between a short-term interest-bearing note payable and a long-term interest-bearing note payable. The only difference really is the length of time for which the note will be outstanding. The present value of the note is equal to the face value of the note, just like with short-term notes payable. And the cash flows are typically for cash received today and for interest and face value repayments in the future. Now, a traditional interest-bearing note payable, those are occurring less often in business today, but they still do exist. So it is possible for a financial institution or other lender to write a note payable with a stated rate of interest. We borrow, say, $1 million today and agree to repay that $1 million plus accrued interest 2 years from now or 3 years from now. That would technically be a long-term note payable. Traditional interest-bearing, the only cash flows that occur are today when we borrow the money, and then the maturity date when we repay in lump sum the principal as well as interest. Second common type of long-term note payable are the non-interest-bearing note payable, or the discounted notes. This is again going back to the discounted notes that we talked about earlier or previously. Once again, the difference here between a long-term and a short-term discounted or non-interest-bearing note payable is just the length of time that the note is going to be outstanding. Similar kinds of issues we have to deal with. Non-interest-bearing notes payable, the present value or the cash inflow today is going to be less than the face value of the note. We have that implied or implicit interest rate, that's the discount that we need to account for. And so again, similar to the the interest-bearing note, we typically have just two cash flows, the dollar amount that we get today and the dollar amount that we will repay at the maturity date. The third type of note that we see in business, and this is the note payable that you and I are more commonly associated with, and that is an installment note payable. So whereas an interest-bearing and non-interest-bearing notes, those are cash flows in today and cash flows out at some point in the future, an installment note payable is once again something that you and I are familiar with. If you borrow money to buy a car, you are signing essentially two documents. You sign a whole bunch of things, but realistically you're signing two documents. One is you are signing a promissory note, a note payable, promising to repay the principal amount and accrued interest. And you're also signing a lien, which means that if you default on the note, then the bank or whoever you're borrowing the money from can come and repossess the assets. They have a claim to specific assets. But the note itself is typically going to be an installment note, and that means that we are going to be making payments periodically along the way, and those payments will be for a combination of interest and principal. So when you borrow, say, $15,000 to buy a new car and you sign an installment note payable, you are going to be making monthly payments, and those payments are going to be a combination of principal repayment as well as interest. Conceptually, what happens here with a long-term installment note payable is the present value is going to be equal to the face value. So you sign a note payable with a face value of $15,000. That's what you're going to get today in terms of present value. And then you will be making payments on that note payable, splitting up the cash flow between principal repayment and interest payment. So those are the three common types of long-term notes payable: interest-bearing notes payable, non-interest-bearing notes payable. Those are both exactly the same as the short-term notes payable that we talked about previously. The only significant difference is that the maturity date is going to be more than 1 year from the balance sheet. The new one is going to be installment notes payable, and that's where we receive an amount of cash today, and then we make periodic monthly or quarterly or semi-annual payments, or maybe even sometimes annual payments, and each one of those payments is a combination of principal and interest. In one of the subsequent videos, we will look at how to measure, recognize, disclose, and analyze these various types of long-term notes payable.